Picture this. You've got a company that's bleeding cash, constantly posting losses and sitting on negative earnings per share. But somehow, its stock is up over 400% in a single year. No way, right? Well, Wall Street is completely divided. On one hand, short sellers are screaming that it's all a supply chain illusion. On the other, top analysts are projecting 101% upside. So what exactly is going on with T1 Energy? Okay, let's dive into this explainer and unravel the billion-dollar mystery behind one of the market's absolute most controversial stocks. To really wrap our heads around this controversy, we've got to look at the immediate financial paradox staring us right in the face. For the full year of 2025, T1 Energy posted a net loss of $385 million. That leaves them with a negative earnings per share of $1.88. At first glance, that's a massive red flag. When most folks see a negative EPS that severe, they naturally just assume the business is going under. But in this case, that negative number is actually hiding a much, much larger structural transformation. You see, T1 Energy wasn't always T1 Energy. It actually started out as a Norwegian battery startup called Freyr Battery. But back in 2025, they executed this incredibly aggressive high-stakes pivot. They basically acquired Trina Solar's 5-gigawatt U.S. module plant and completely rebranded. Today, they're running their G1 Dallas facility, actively churning out solar modules, and looking ahead to the fourth quarter of 2026, the first phase of their G2 Austin solar cell factory is expected to finally come online. Their ultimate goal is wild. They're trying to build America's very first fully vertically integrated solar manufacturing platform. Everything from raw cells to finished modules, all made right here in the USA. Now, what's really interesting about this slide is how it forces us to completely rethink what a loss actually means in the business world. Because look, not all negative earnings are created equal. On one side, you have destructive losses. That's when a dying business literally can't sell its products and the cash flow just permanently dries up. But then you have constructive losses. That's when a company is deliberately sacrificing its short-term profits, plowing every single cent back into capacity expansion and structural growth. And T1 Energy, they are heavily, heavily weighted toward that second bucket. Let's break down exactly how massive this constructive cash burn really is. Their G2 Austin cell factory alone comes with a staggering total project price tag of $850 million, and they still need roughly $225 million just to cross the finish line for phase one. When you look at their projected revenue allocation for 2026, they're dedicating about 33.4% of their revenues straight to capital expenditures. Think about that. For every $100 they make, over $33 goes directly back into building factories and buying heavy machinery. So this isn't an operating loss where they're just failing to sell stuff. It's a massive, incredibly deliberate reinvestment strategy. To put this all into perspective, think about the investing philosophy from greats like Warren Buffett. The core idea is that every dollar lost on the income statement today is actually a dollar being invested into a structural advantage for tomorrow. T1 Energy is literally pouring their capital into building a massive domestic manufacturing moat. They're totally fine with sacrificing the appearance of near-term profitability if it means capturing a giant slice of the future U.S. energy market. But honestly, capital expenditure is only half of this negative EPS puzzle. The other half is tied to this very specific policy under the Inflation Reduction Act called the Section 45X Production Tax Credit. Basically, this policy is set up to heavily incentivize domestic manufacturing by offering a per-watt tax credit for U.S.-made solar modules. The really crucial detail here is that this policy generates tradable tax credits rather than just traditional product revenue. And T1 Energy is capitalizing on this in a huge way. Back in December 2025, they completed this massive $160 million sale of these exact 45X credits, getting 91 cents on the dollar. So they are generating tremendous real-world cash value. But because it arrives in the form of tradable tax credits, the accounting gets, well, incredibly complex. This accounting nuance creates this huge, weird discrepancy between the book losses you see on paper and the actual hard cash flowing into the company's bank account. So the crucial point is hiding right in their Q1 2026 performance. While their bottom line shows this massive total net loss of $21.4 million, their core continuing operations actually turned their first ever profit of $3.9 million. And they posted a positive adjusted EBITDA of $9.1 million. So why the huge gap? Because that net loss is being heavily dragged down by the costs of winding down and getting rid of their old legacy battery operations. The actual core solar engine, it's finally starting to hum. Section 1. The Fuzzy Panda Conflict, Short Seller Allegations and Supply Chain Risks. Of course, anytime you have massive growth like this, intense scrutiny is going to follow. In May and June of 2026, a short seller named Fuzzy Panda Research dropped some serious reports targeting T1 Energy. To understand what they're arguing, we first need to quickly define FEOC rules, which stands for Foreign Entity of Concern Regulations. Basically, these are strict federal rules designed to make sure that critical U.S. supply chains aren't relying on adversarial nations. If a company's supply chain violates these rules, they can get completely disqualified from receiving all those lucrative federal tax credits we just talked about. And it turns out these short sellers can cause a very real multi-million-dollar headache. According to their reports, whistleblowers provided 26 bilingual invoices. These supposedly suggest that T1 Energy made over $65 million in sell purchases from China's Trina Solar during the first quarter of 2026. So the core accusation here is that T1 Energy misled its investors about cutting ties with their former Chinese partner. And if that's true, they'd be violating FEOC rules, putting their entire business model in serious jeopardy.
And this brilliantly illustrates exactly what's at stake here. I mean, the financial stakes couldn't be higher. Those 45x tax credits are literally the lifeblood of T1 Energy's current profitability. With the credits, their projected Q1 EBITDA was a solid positive $9.1 million. But if they're found in violation of those FEOC rules and actually lose the credits, that EBITDA swings violently to a devastating negative $32.3 million. We are talking about a massive financial cliff.
Now, to be completely objective, there are two sides to every market conflict, right? T1 Energy and several Wall Street analysts have pushed back incredibly hard on this. Firms like Roth Capital have publicly come out and labeled the short report as straight-up misleading. The company itself maintains the construction at the G2 Austin plant is fully on track. And honestly, perhaps most importantly, they've stated that forward customer demand for 2027 and 2028 already exceeds 100% of their expected capacity. For these emerging high-growth stocks, a fierce battle between short sellers and management is often just part of the standard risk premium that investors have to navigate. Section 2. Testing the value legends. Does T1 Energy pass the ultimate investor tests? Let's move to and see how this builds against some proven frameworks, because when a company is this volatile, you really want to stress test it. But looking at the scorecard, the reality is pretty harsh. Benjamin Graham looks for positive book value and consistent earnings. T1 Energy has negative book value and is bleeding cash. Reject. Peter Lynch looks for positive EPS to calculate a PEG ratio. T1's EPS is so deeply negative, the ratio can't even be calculated. Reject. And Warren Buffett, he wants positive owner earnings and a wide, established moat. T1's owner earnings are negative $13 a share, and their moat is still entirely theoretical right now. Reject. So what's the takeaway? Pure value investors should absolutely walk away. But that doesn't mean the stock is worthless. It just means its true value lies completely outside of those traditional boxes. And that brings us to the bull case, which really frames T1 Energy as this high-reward build-out story. The optimists are looking at three massive structural tailwinds. First, the absolute explosion of AI data centers is driving insane demand for utility-scale solar, which happens to be the cheapest new-build power source in the U.S. right now. Second, there's a literal regulatory fortress forming around domestic manufacturers, thanks to tariffs and those 45x credits. And third, if their vertical integration plan actually succeeds, management is targeting an astonishing $1.8 billion in revenue and nearly $190 million in earnings by 2029. Plus, its current price-to-sales ratio is sitting below the industry average, which makes it look kind of cheap given its massive growth potential. But listen, you absolutely cannot look at those tailwinds without immediately confronting the severe, honestly borderline extreme risks of the bear case. To fund this massive dream, the company has heavily diluted its stock. They recently doubled their authorized shares from 500 million to 1 billion. On top of that, short interest is sky high, with 17.5% of outstanding shares actively betting against the company right now. It's an incredibly capital-intensive operation, needing another $225 million in near-term funding. And yeah, there's still that totally unresolved legal and compliance overhang regarding their supply chain. So make no mistake, this is a total powder keg of volatility. So bringing everything we've covered in this explainer together, who is this stock actually for? Well, T1 Energy aligns specifically with high-risk growth speculators. It's really built for investors who have a deep, fundamental belief in a U.S. manufacturing renaissance and who are totally willing to bet on the policies driving it. But above all else, it requires long-term holders. I'm talking about people who possess the iron stomach necessary to endure negative earnings per share, massive capital expenditures, and potential drawdowns of 50% or more while these factories are literally being built from the ground up.
On the flip side, it is abundantly clear who needs to stay far, far away. If you're a value investor looking for a comfortable margin of safety, yeah, this is definitely not your stock. If you're an income investor relying on steady dividends, look somewhere else, because this company is going to be reinvesting every single penny back into the business for years. And if you're a conservative investor who loses sleep over extreme price volatility, the transitional costs, the operational risks, the fierce short seller battles, all of it makes T1 Energy entirely unsuitable for your portfolio. Ultimately, seeing a negative EPS doesn't automatically mean a company is failing, just like a surging stock price doesn't automatically guarantee success. Being able to understand why a company is losing money, whether they're engaged in constructive reinvestment or just suffering from destructive operations, that's the real skill that separates informed investors from the rest of the pack. So I'm going to leave this question to you. Based on the hard data, the aggressive factor expansions, and the intense short seller scrutiny we just went through, is T1 Energy destined to be the next great American solar champion? Or is it really just a well-disguised supply chain illusion? Let me know your take in the comments below. Thanks so much for joining me on this explainer, and as always, keep questioning the numbers.